Hello, everybody. At this time, we are talking about systematic risk. Systematic risk is unpredictable and impossible to completely avoid. It is also known as volatility risk or market risk. It is the result of macroeconomic events that affect the market as a whole and cannot be controlled, at least by an investor. The Great Recession is a primary example that investors can adjust their portfolios accordingly. However, and then we move to types of systematic risk. The first type, market risk. Market risk is caused by the herd mentality of investors. Market risk is the tendency of security prices to move together. If the market is declining, then even the share prices of good performing companies fall. Market risk constitutes almost two-thirds of total systematic risk. Therefore, sometimes the systematic risk is also referred to as market risk. Market risk changes are the most prominent source of risk in securities. Second types, purchasing power risk. Purchasing power risk arises due to inflation. Inflation is the persistent and sustained increase in the general price level. Inflation erodes the purchasing power of money. Therefore, if an investor's income does not increase in times of rising inflation, then the investor is actually getting lower income in real terms. Fixed income securities are subject to a high level of purchasing power risk because income from such securities is fixed in nominal terms. It is often said that equity shares are good hedge against inflation and hence subject to lower purchasing power risk. And then third, interest rate risk. Interest rate risk arises due to changes in market interest rates. In the stock market, this primarily affects fixed income securities because bond prices are inversely related to the market interest rate. In fact, interest rate risks include two opposite components, price risk and reinvestment risk. Both of these risks work in opposite direction. And then fourth, exchange rate risk. In a globalized economy, most companies have exposure to foreign currency. Exchange rate risk is the uncertainty associated with changes in the value of foreign currencies. Therefore, this type of risk affects only the securities of companies with foreign exchange transactions or exposure, such as export companies, multinational companies, or companies that use imported raw materials or products. And then, how can investors effectively mitigate the impact of systematic risk on their portfolio? To effectively manage systematic risk, investors should employ a diversified investment strategy This involves allocating assets across various asset classes, such as cash, real estate, and fixed income securities. Each asset class exhibits distinct risk-return characteristics, allowing investors to potentially offset the negative impact of systemic events. For instance, during periods of rising interest rates, certain fixed income securities, such as newly issued bonds, may appreciate in value. Conversely, some equities may experience downward pressure as investors anticipate corporate cost-cutting measures. By maintaining an appropriate balance of income-generating assets, investors can potentially mitigate the adverse effects of interest rate fluctuations on their equity holdings. And then we move to benefits of systematic risk. The first benefit, better investment options. Investors can analyze risk exposure and choose investments with appropriate levels of risk. Second, regulatory compliance. Systematic risk analysis is utilized by financial institutions to comply with risk management regulations. Third, portfolio optimizations supports asset allocation and risk management strategies is very important for business. And fourth, macroeconomic insights provides a broader overview of economic conditions that affect the investments. And fifth, risk-adjusted returns permits calculation of expected returns implying CAPM, which helps the investors compare investment. And then mitigating systematic risk. Using a wide variety of asset classes like fixed income and cash is one way to mitigate systematic risk because each asset and class reacts differently to systematic change. For example, take a look at the Great Recession of 2008 when the recession hit risky securities and stocks were decimated and sold off in large quantities. Meanwhile, simple assets like treasury bonds gained more value because they are generally perceived as a safer option and people were buying them up as they sold off stocks. An individual who was invested in both would have mitigated their systematic risk as opposed to somebody who was only invested in stocks. And then causes of systematic risk. The first cause, investors' behavior. Investor sentiment and psychology significantly sway markets. Market exuberance or panic leads to volatility spikes. Second, economic bubbles. Overvaluations and bubbles in assets like housing and dot-com stocks fuel systematic risk. Their inevitable bursting leads to crisis. Third, leverage. Widespread use of leverage exaggerates market movements when investors are forced to cut positions suddenly. Fourth, high-frequency trading. Algorithmic and high-speed trading by large institutions can trigger flash crashes through cascading sell-offs. And then finally, we move to the difference between the systematic and unsystematic risk. The first unsystematic risk is specific to a particular industry, segment, or security, while the systematic risk is associated with the entire market or segment. And the second, unsystematic risk can be mitigated through measures such as proper management and diversification of investments. In contrast, systematic risk cannot be eliminated entirely and requires investors to accept some level of market risk. I think it is enough. Thanks for watching.